When someone says have a relationship with a banker, this is something that I think is incredibly important. They don't mean go to your local bank, to a big bank, and just open up an account. They mean far more than that. I believe they mean to have a relationship with an actual dedicated person that you know by name, that if you walked into a branch could know them. If you emailed them, you would know their actual name instead of just like info at whatever bank. How does one, I think you agree with me on that, but how does one establish that relationship with a banker so that when things like this do occur, or so that they want to get better with their business, that they have someone on their side? How does someone start to create that relationship with an actual banker?
Well, that's a good question. One of the challenges that a lot of small business owners are going to face now is if you walk into your local bank, particularly if it's a regional or national bank, you're going to be talking to a person that can help you with questions about your checking account, et cetera. But when it comes to the loan side, the process they have in place is either going to be automated, that is, it's going to be online, or it's going to be centralized to the point that the person you're talking to in the branch really has no impact or input into the loan decision process. So I'm not saying you automatically therefore need to go to a local bank, that et cetera, but that's going to be the challenge I think a lot of small business owners have, and they have had, particularly with the COVID related financing, is the people making the credit decisions are not in the branch level. The branch people have very little, if any, input into it. And to get to a commercial or business banker, you have to be a certain size business. And a lot of these micro businesses that we work with are not large enough, nor that they have the time to try to figure out how their bank operates. So they really are at a loss when this kind of situation comes up. And that's where we try at the SPDC to help out, saying, okay, this is the reality you face because you're dealing with this particular institution. These are the realities you're going to face in working with them. We're not trying to pass judgment on particular lenders, but we're going to say, this is what you're going to have to expect. You're going to have to conform to their requirements, and rather than the other way around. And this is one reason why I think fintechs have become so prominent, is because the personalized nature of banking has changed so much.
Yeah, they don't care.
That why not go to a fintech? Why not go to a place that's in Ohio or somewhere else? Because it's all vanilla, and the banking industry's kind of done that to themselves.
And from a banking perspective, one of the C's is character, right? And so that character is by having a relationship with someone, and the banker, lender deciding whether or not they think they're credible, basically.
Yeah, and that's where the character lending has impacted some particularly idle borrowers, but also some PPP borrowers, as they've been declined because of credit issues. And particularly with PPP, it's hard to understand because there's no personal guarantees on a PPP loan. So why is personal credit an issue? Well, credit is you mentioned character. Personal credit is the way that lenders, including the SBA, assess the character of the business and the borrower. Rightly or wrongly, that's the connection they make. If you pay your personal bills on time, the SBA and lenders say that you've got acceptable character. If you don't pay your personal bills on time, then they say you lack character. So that's unfortunately how the personal credit kind of bleeds into the whole process for small businesses. And we've had, again, borrowers that applied for PPP and got turned down because one of the PPP application questions is whether or not you're involved in a bankruptcy. And I had one case where it was two siblings that co-owned a business. One had okay credit, the other was in a Chapter 13 bankruptcy. They got turned down for a PPP loan because of the active bankruptcy. Even though the credit was not, you would think it shouldn't be a factor because there's no personal guarantees. The lender decided that they wanted to assess the character, and the SBA assessed character by the act of bankruptcy, and therefore they were not eligible.